After my interview with Dr. Lacy Hunt, he offered to answer 2 questions. Here's those questions and his answers. Question number 1, we know during the next crisis, market downturn, or liquidity event, the Fed will be back with an even larger barrage of QE. Is there a point where a central bank's balance sheet can be too big and could destabilize the system? Or is it possible for the Fed someday to own every U.S. Treasury and mortgage-backed security without any negative consequence to the financial markets? Here's his answer. This will be destructive to the economic growth in 3 ways. First, moral hazard will fall increasingly by the wayside. Second, Schumpeter's creative destruction will be less operative, meaning that we will experience an even greater misallocation of resources. Moral hazard and creative destruction are essential ingredients that cause the free market economies to excel over command and control economies. Third, the increasingly greater coordination of monetary and fiscal policy will shift the economy further into the direction of a command and control economy, shifting more of the pie from the high multiplier private sector into the negative multiplier government sector. Thus, we will move the United States further in direction of Japan, Europe, and China. As the growth in the standard of living becomes increasingly frail, this will worsen the income and wealth divides. This is likely to have social consequences. At some point, the advocates of command and control will recognize that even higher levels of debt are not the solution, and the risk is that they will make the Fed's liabilities legal tender, i.e. medium of exchange, store of value, and unit of account. Then the standard of living will collapse in an environment of rampant inflation as Gresham's law takes effect. Here's question number 2. We saw Treasury yields fall during quantitative easing 2 and 3's taper and after when quantitative easing ended. The common belief today is a balance sheet taper or end of quantitative easing will lead to significantly higher yields. Is there a reason a balance sheet taper leads to lower yields, and why? Or is it just coincidence? The key to the answer here is to recognize that the M2, money supply, equals the monetary base times the money multiplier. Thus, the M2 money supply growth will slow by multiple as the Fed tapers. Due to fiscal policy, aggregate debt levels are likely to continue to move higher, resulting in an ongoing decline in velocity, referring to the velocity of money. Thus, the reduced M2 growth will fall predominantly on the financial markets, but the real economy will also be adversely impacted. This process will take some time, as the tapering does not start until November 15th, and it will be slow, although we soon will find out that that's different. No one knows how much the Fed can actually accomplish before they're forced to end the tapering. Hope you enjoyed this interview and these follow-up questions. The content of this video was provided as educational information only. It's not intended to provide investment or other advice. It is not to be construed as a regulation or solicitation to buy or sell any security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. The opinions expressed in this video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.